Hey everyone, it's Daniel here from InfoRest. Hope you're all doing well. So the Federal Reserve finally did its final rate hike for this year. A 50 basis point rate hike, which brought rates to basically 4.5% in a range of 4.25 to 4.5%. And what a wild year it has been. I remember back in 2021 in December when the Fed was talking about possibly doing only 2 or 3 rate hikes. I remember in 2021 when Fed said that inflation was transitory. I remember also that as soon as 2020 hit, we started talking about QT. We started talking about ending the balance sheet of quantitative easing, not printing so much money, completely stop the buying of bonds and rolling off the bonds, and also doing rate hikes and increasing the rate hikes to from 0 to all the way to 4.5%. So this was the last rate hike of the year. Does this mean that this is the end? Does this mean that rate hikes are done? Are we completely done with it? No, we're not. And I'm going to explain it in a second or two why we're not, and what the Federal Reserve said, and what they came out and basically told the markets. Now, what's very interesting is that in 2020, when we had the COVID crash, we had quantitative easing, we printed a lot of money, we also had rate cuts that were slashed all the way 0%, and the results of that showed in 2021. Higher inflation, higher prices, asset price inflation, stock markets going up, meme stocks all over, going like crazy, GameStop, AMC, you had Dogecoin and Bitcoin, crypto markets exploding. I mean, what a wild ride, right? It's crazy. 2020, 3 months, like a quick crash, then completely reversing in 2020 March, and then 2021 just moving up on steroids, just this pump, this money, and this money printing, and equities and real estate just going like crazy. You're hearing, in the US and Canada, big funds, Blackstone, BlackRock, coming out buying properties, coming out buying assets, people lining up to get a house, whether it's in Texas, Houston, or another place, or people getting outbid without even checking the homes, just saying, hey, I'll sign as is and I'll buy whatever price it is, and there we go. To now 2022, where we the Fed flipped, where they said that in 2021 that inflation was transitory, and they came out, admitted in December of 2021 that they were wrong. Then they came out in January and said we're going to tighten. In December of 2021, they said that we're going to only increase interest rates 2 or 3 times, and then in 2022 they completely changed and raised rates in every single meeting that they had this year. They meet about 8 times, and they started with the 25 basis point rate hike and ramped it up to 50, ramped it up to 75. They didn't do a 100 basis point rate hike, which was quite shocking to me. I thought they would do something like that. Instead, Bank of Canada did a 100 basis point rate hike, but the Fed never did so. But they still did big, massive rate hikes, and we went from 0 to 4.5%. So this is it. This is the end of the rate hikes for this year. This is not the end for next year. So the Federal Reserve came out, they released their statement, they came out, and the statement was as is, there was not much change in the statement. So everything that they said was in line. What was a little different was in their projections, they showed that next year growth, GDP, would drop heavily to about 0.5%. And the inflation is a tad bit higher next year, but still coming off from this year's level. And most importantly, which caused stocks and bonds to basically sell off, was their Fed funds rate, where they projected, and their dot plot projecting that rates would probably be around 5.5 1%, which was higher than what the market was expecting, and that's why we had that quick sell-off. But to me, when I was looking at this, okay, 5.1%, so we already know that the Fed mentioned that they're going to continue raising rates next year, but at a slower pace. So they're not going to do the massive rate hikes that they've been doing unless data suggests that they should do so. But they're going to go with, the 50 basis points for next year. But they came out with 5.1, which may suggest that 50 basis points and then maybe another 25 basis points. And they left it open saying that, we will see where the terminal rate will be dependent on data. Could we stop rate hikes? Sure, they left that door open, but again, dependent on data. And they hammered again and again that inflation needs to come down. We need to hit the 2% target. That's our goal. We're not done. The job's not done, which is basically what they've been saying all this time, right? Which we've been hearing, which what I've been saying in the videos for all this time, that it was expected. So it was fully expected. Bonds completely reversed its move. The short end still, reversed basically half of or more than half of its move. The stock market, same thing, reversed about 75% of its move, and then as soon as the press conference was over, then we had profit taking, and again the market sold off, and now it started to pick up a little bit, but the markets are closed now. But what a wild swing. Initially it was a knee-jerk down followed by a reversal. The meeting was as expected. The only little tiny nugget of little hawkishness was the 5.1%. And again, you're going to have to be data dependent, and we'll see where rates go. Now, what's very interesting is the bond market is not agreeing with the Fed. The Fed says they're going to continue raising rates. There was a question during the press conference that says, hey, you're suggesting very low GDP. Are you suggesting a recession coming in? Powell's like, no, we're suggesting that soft landing, nothing's bad's going to happen, etc., which I call BS. With those kind of data and those kind of numbers that are coming out, definitely I do believe that there is going to be a recession that comes, and I believe that the Fed is trying to create this to bring demand down, to bring the unemployment rate higher, to bring wages down, inflation, and that's how you fight inflation. Now, again, when we look in previous history, it takes about 2 to 3 years for inflation to come down. When you look at past recessions, it was a recession that really brought inflation down. So that's what the bond market is expecting. It's calling the Fed's bluff. It's saying that no, we don't think you're going to hit 5.1%. The terminal rate should be around 4.7 to 5%, around there, so a little bit lower. And we believe that you're going to stop in 2023. Sure, you could pause rates for some time, but we believe you're going to stop. And why would you stop? Because probably the data is getting worse off, and signs of weak demand, signs of some sort of massive recession, which would make sense for the Fed to say, okay, we need to pause. And then when the pause happens, you can start talking about the pivot, right? But the equity markets are way too over optimistic about a pivot, especially this year. It kept every small little data point that came in, especially with inflation, that came in weaker than expected. We saw a big rally in the equity markets thinking that, oh, the pivot's coming. If you look at last CPI's number, the number came out weak. Actually, yesterday's CPI number came out weak, and the markets rally completely reversed. Fed came out, we sold off and then reversed that as well. So a lot of choppiness in the markets, but definitely, the pivot will come once something breaks. That's how I view the markets. That's what I think where Powell is going to take this is to continue to be data dependent, continue to watch what's coming out from the data and make his decisions based on that. And very likely that, he's probably, if he continues to raise rates, he's going to over tighten. And if he over tightens, then definitely the bond market's going to scream and say, hey, you gotta cut rates now because things are getting ugly. And generally we've seen that in the past where the Fed, right, over tightens, makes a mistake, and generally follows what the bond market has been predicting. So it'll be very interesting to see in 2023 who's right, who's wrong, and definitely you can see a very big discrepancy. You could see there's, where the bond market and Powell and Fed are agreeing to disagree. They're both agreeing to disagree, where the bond market says no, you're going to stop, and then it's going to lead to rate cuts very soon, and the Fed's like, no, we're going to tighten. So let's see who's right, who's wrong. But definitely this meeting was not a surprise. It was as expected, 50 basis point rate hike. And guess what? The effects of all this tightening this year, we'll see in 2023. So we'll see what happens. So leave a comment below. Let me know what you guys think. And hit the like button, subscribe button, and the bell icon to be notified on the next video. And I'll see you guys around. Cheers.